Are off the lows we hit earlier this hour when the Dow was down about 300. We've actually come back significantly. The Nasdaq's back into positive territory. This uncertainty around tariffs that we heard from the cabinet meeting from the president could be one cause of the volatility this afternoon. Here to discuss that and more, Jason Ware is CIO and head of research at Albion Financial. Jason, you hate tech stocks. Welcome.
Definitely not. Do not hate tech stocks, but I will say after over a decade of being quite overweight, I am much more sensible about what's possible in the coming years. I don't know where these stocks are going to trade in the next few months, but as we look out over the next 5 and 10 years, there's just no way they can continue to compound at the race that they have. It's just simple math. If you look at Google and Alphabet and Microsoft, Amazon, et cetera, they've been growing at over 20% per year. Just to give you an example, Apple were to continue to do that over the next 10 years, it'd go from a $3.6 trillion market cap to almost a $30 trillion market cap. So we still like them. We still own them. Great businesses, just at smaller position sizes.
What if the market caps don't change? What if it's just, earnings and buybacks? I mean, well, actually, Apple's not a great example of that. But look, a lot of people look at the valuations and go, they're not even that steep. So I take your point about their sheer size, though.
Yeah, and the valuations aren't steep. I mean, Mag 7 is trading at 39 times when you include Tesla. When you take Tesla out, which has 100 PE, it goes to about 29 times. So sub 30 PEs for companies that are growing high teens, a peg of about 1.5 is not terrible. But again, I think we just need to be realistic about what's possible. So we've right-sized those positions, but we still own them, and we still think you should own them. These are the best management teams, best businesses, wide moats, good balance sheets. No reason to sell them, but just be more realistic about, the forward path.
I didn't ever think we would see trillion-dollar companies consistently. Right. I just figured, competition takes over at some point, and yet it's the new normal. I mean, we had a guest last hour who was bullish on Amazon say they're going to do $1 trillion in revenues by 2028.
Yeah, and we agree. They're going to do $700 billion this year. That is something that we absolutely see as well. And so these companies, they can double. I mean, Amazon can go to a $4 trillion market cap. Apple and Nvidia, they can be 6, 7, 8 trillion. I don't have any problem with that kind of thinking. In fact, that's our base case expectation. But again, as we think about the ability to, be 3, 5, 10 baggers, that's just where we get a little bit more cautious, and we've been a little bit more realistic in how we want to size based on that. And there are lots of other opportunities in the marketplace where we can spread out that capital.
Okay, but United Health, don't tell me you think that's a 3, 4, or a 5 bagger.
I guess it depends on the time frame, right? But I will say it's a cheap stock. This is trading at 15 times forward earnings now. This was a quiet compounder for so long until about 3 months ago. Now it's been taking on water. There's no question. But the earnings profile, the earnings power of the company, we think is not changed. What has changed is the stock is re-rated lower, is trading at a 25% discount to its own historical PE. It's trading at a discount to the S&P by almost 10 turns. And anytime United Healthcare gets this oversold, unless there's a fundamental impairment on the earnings, we don't think there is, it's a stock to be bought, not sold.
What do you think is going on in the market more broadly right now? This churn that we're seeing, the collapse of the momentum names, and weirdly, it's accompanying a collapse in interest rates. You could easily make a story, rates are back up to 5 and the momentum's coming out of the bank. No, it's the opposite. It's all kind of tilting underwater.
Yeah, it's a keen observation, Kelly. And the way that we think about it is that the drop in the 10-year yield is a reflection of kind of this growth scare that seems to be bubbling up, almost a vibe shift, if you will, in the markets, where we went from tax cuts and deregulation and pro-business and animal spirits to this period where people are now pausing and rethinking that and wondering if the offsets of tariffs and DOGE being perhaps heavy-handed in terms of cuts and job growth and those kind of things at the federal level, whether that might upset the apple cart. Our view is that that's not going to be the case, that earnings will come through this year. We're quite bullish on corporate earnings. We think the economy's okay. Inflation is benign. Yes, it's above Fed target. It's sticky. But we think the cocktail for stock prices to continue looks pretty good despite the volatility recently.
It's not just healthcare. You like Thermo. That's another one. But also, and this might catch some people by surprise based on your earlier remarks, you like NVIDIA. You like Salesforce. You like Uber.
Yeah.
I mean, you like Broadcom.
See, we still like tech, Kelly. Still big fans of tech, but you just have to be, I think, a little more diversified, and you have to pick your spots. Salesforce, you guys were just talking about it a moment ago. As I look at this is a sub 30 PE for a company that's going to continue to compound earnings at around 15%. They're the number one leader in CRM and cloud in that space, and they have agentic AI, which we're very bullish on over the next 5 and 10 years. Broadcom, you're not sure whether you want semis or software. It's a great play because 40% of their business is in high value software. Meanwhile, they're doing custom chips for AI, which we think is kind of the next wave as we get more to inference. And then, of course, NVIDIA, we're underweight NVIDIA, but we still think it's one you have to own. GPUs, still huge demand. We think Blackwell's going to be big this year, moving to Rubin. And then, of course, there's physical AI coming. So still a stock we want to have in the portfolio, just at a smaller size.
Mystery man. Jason, thanks so much for joining us. Appreciate it. As everyone's kind of reconsidering their portfolio. Jason Ware of Albion Financial.